And that's what I learned this year a lot is humility, right? We have to.
Those are tough lessons, man. Those are tough lessons.
Experience is what you got when you didn't get what you wanted. So,
I love it.
And I think there's going to be 2 decent pullbacks next year. I think we're going to get one here pretty quick into the end of January, beginning of February. Confidence comes with humility. Confidence comes with no matter how good I think I am, I can still get this wrong. What am I missing? And that really helps to round out kind of the thesis.
Welcome back to the final Intelligent Investment Show of 2024, presented as always by ARPG and their fearless leader, who joins me as always, Matt Dahl. Matt, good to see you again, brother.
Happy Friday, my friend.
Happy Friday. Happy final Friday of the year. And as of, what is it right now? 1:05-ish Eastern time, December 27th, year of our Lord 2024. Market's not being the friendliest today.
No, the market's having a bit of a tough day. I mean, I think it's end of the year. I think what's taking place is it's pretty simple. There's just, volume is very, very low right now, right? No one is really engaged. We don't have a lot of traders out there really pumping right now. So any move, if it's a sell move today, right? If our declines to advance today, it's going to be amplified because the volume is low. And I think that's a big part of it. And I think what sort of catalyzed the selling over the buying today was yields. Obviously, we're sitting at 462 on the 10-year right now. And I think that maybe the 4.6 was sort of a threshold with some of the algorithms, right? And it started some selling a little bit. And, again, with the lack of volume, I think it just kind of amplified the move a little bit. And, there's been a lot of money made this year in a lot of places. And what's selling off today is the NASDAQ. It's your big, it's your Apples, it's your NVIDIAs, it's your Microsofts, it's your Metas, all of those. So I think that's a big part of it. I think there's just a lot of profit taking today that's taking place. And I think this is just sort of a canary in the coal mine, so to speak. This is a dress rehearsal of what's going to take place after the first of the year when people start doing, their tax gains. To me, I wouldn't want to do a lot of selling right now before the end of the year. I'd want to do my selling after the first of the year. So, those gains will be realized in the following year. So I wouldn't have to worry about it until 2026. But, everyone has their own situation they have to deal with.
Yeah, I mean, I think conventional wisdom would be, and correct me if I'm wrong on this, but conventional wisdom would be that in a big up year like we've had this year, that you would probably see profit taking or capital gains harvesting. They usually hear that the other way around, capital loss harvesting, but capital gains we would want to punt that into the new year if we could. So conventional wisdom would be on that maybe there wouldn't be as much selling in December, especially late December, as maybe some other years, but then across the other side of on the other side of the new year, you could see a massive sell-off to start off January as everybody who waited to kick their capital gains out one more year, wait till January, and then they start to book it. However, even that then trips another domino off of the smart investors, quote unquote, might look at that and say, well, I don't want to sell into the middle of a sell-off. I would rather go ahead and take my profits now and I would rather pay taxes in 2024 on higher profits than wait till 2025 and sell into a sell-off. And yeah, I'm going to get to kick my profits down the road another year, but because I'm selling into a sell-off, those profits are going to be a lot smaller than if I do them now. So is there always sort of this like tug of war that you never really know where that profit taking is going to take place?
Well, it's anyone's guess, right? And, there's always the good old saying, a bird in the hand is worth two in the bush. We don't know how fast and how gnarly that profit taking is going to be next year, if at all. So anyone who's doing their selling now, yeah, they're realizing a high price and a good gain. So that's good for them. If you want to take a kind of a recent example of it, look at 2021. 2021 was, just a rock star year, right? That's when things were going nuts. And then, of course, we all know what happened in 2022. But the end of 2021 was just incredibly strong. The market peaked, the former market peak that held for quite a while was January 4th of 2022. And then from there, it just deteriorated. You saw a lot of buying and no one wanted to sell their gains in 2021 until the next year. And it started quick. So we know 2022 was a really tough year. So as you got to the end of 2022, what did you see? We had obviously those big tech heavy NASDAQ positions that had a real good 2021 had an awful 2022. So when the market actually bottomed on October 12th of 2022 at 35, basically 35.75, right? It started to come back up in November, but then in December it really tapered off, especially in the very end of December, and the Nasdaq just rolled right back over at the very end of December. That's when everyone was realizing they were doing their tax loss harvesting, specifically in those bigger tech positions, in those bigger Nasdaq positions, right? And then of course 2023 happened, and we were kind of back off to the races. So you can kind of see a real great juxtaposition, the end of 2021, beginning of 2022, and then the end of 2022, beginning of 2023. You saw tax gain harvesting the beginning of 2022 and tax loss harvesting the end of 2022. I think what we're going to see this year, I think we're probably seeing a few. I don't suspect this is going to last all that long. I would expect Monday and Tuesday to be pretty decent days. And, like I said, I kind of thought we kind of finished the year right about 6,000. I know there was some talks that people were going to go 62, 6,300. I don't see us getting quite there, but 6,000, is probably why we might be 50 points either side of that number, right? But I don't see a whole lot of more gas in the tank for this year. I do see the potential for people taking those gains and taking those profits, probably in the first 1 to 6 weeks of 2025.
Yeah. So we were talking yesterday about your outlook for 2025, and this was really interesting to me. So you were telling me, give me the FundStrat numbers and sort of their outlook for 2025. And it was interesting. You said that you kind of have yourself getting to the same finish line as at the end of 2025 as FundStrat. You kind of agree with their end of year number, but you have a very different path that you see it taking.
Yeah, yes and no. So they have a high of 7,000 for next year. Okay, I have a high of about 7,150. Okay, however, I think we're going to finish next year, and when I say finish, it's usually sort of that last 2 weeks of December. It's kind of I guess you can call it the final day of the year, but we're going to finish next year 7,100, 7,150. FundStrat, and again, FundStrat, those guys they're as good as it gets, and their analytics are phenomenal, and I really like working with them. But they think there's going to be a run to 7,000 by the middle of the year, and then it's going to pull back and finish here at 6,600. Okay, so I think we're going to get sort of the opposite. I think we're going to run to 66, 6,700 by the end of July. Okay, and then it's going to pull back into that August, September, October choppy time of year, and I think there's going to be two decent pullbacks next year. I think we're going to get one here pretty quick into the end of January, beginning of February, into the 5,400 range, 5,500 range, sometime between, call it January 15th and March 15th, somewhere in that time frame. I think we're going to get a pretty significant, pullback of, 10 to 12%. Okay. And I think we're probably going to run to about 6,600, 6,700 right through the end of July. Okay. And that's going to pull back probably to somewhere in the neighborhood of about 5,800, 5,900 right through there. So we're going to get that. And I think that's going to involve the yields as they start to come in. I think next year is going to be a very, very bumpy year in terms of interest rates. Okay. And back to interest rates, I believe if we look at it through the prism of the 10-year Treasury note, right, it's directionally lower. Okay. So I've been kind of toying with this idea. I'm not exact, I think people are always looking for where is the interest rates going? Are they going up? Are they going down? Right? Where is the neutral rate? Okay. I think we can all agree the neutral rate is somewhere around 3%. Okay. So if the neutral rate is somewhere around 3%, then it depends on the speed of which the Federal Reserve wants to get its policy to that neutral position of 3%. Are they going to do it over the course of 12 months? Are they going to do it over the course of 24 months or what have you? Okay. Or are they going to agree on a different neutral number? My thinking is that there has been, the economy is doing well. The economy is obviously likely going to continue to do well. But under the president-elect's policies, I think you're going to see a tremendous amount of business production. And that's not inflationary. That's disinflationary, right? And I think these inflation numbers are going to surprise people as far as how cool they are. And back to where the dot plot was in September of 4 cuts. And in the December meeting, there was only 2. Okay, well, which one was right? Well, they changed the dot plots based on the data that came in in November or October, November, right? That's what took place. Obviously, the data for January, February, and March can change because the next Fed meeting that includes an SEP, a summary of economic projections, that includes the dot plot, is not coming up till March. The Fed meeting in January does not include the SEP. So anything can take place. Any economic data can be released that changes what the Fed thinks they're going to do. But directionally, shelter is cooling off, auto insurance is cooling off. And if you look at the excess inflation, a tremendous amount of, I think 90% of the excess inflation is basically auto insurance and shelter. And we see those coming down pretty quick now. So I'm going to hold the position of, 4, 5, or 6 rate cuts next year. That's where I think we're going to be. And that's how I'm going to build a portfolio. So I'm going to trade against the consensus next year and say, I think we're going to get these rate cuts, but I don't think it's going to move the 10-year all that much. I think we're really going to, what we're going to see next year is a return of term premium, and we're going to see that shorter end of the curve really come down. Okay, and we're going to see that middle belly of the curve, that 7-10 out to the longer end of the curve. That's going to hold itself. So it's anyone's guess. I don't see the 10-year getting all that far away from 4% by the end of next year. It might be 4, it might be 375, it might be at the lower end 350. But I don't see it going, 2.5 or something, somewhere over there. We could very well be 4.5 or 4.25. But I think we'll see a 2-year, probably somewhere in the mid to low 3, probably in the low 3s next year. Okay, and I think that'll be really good for mortgages and things like that, right? So that's where I think we're headed. So you can't really say, well, where are interest rates headed next year, because you really have to then kind of blow the yield curve apart and look at more of the individual components, right? And that's where the short end of the curve is going to make a bigger move than sort of the longer middle end of the curve, right? I don't necessarily think that we're going to have spikes in interest rates next year, because I don't see a lot of inflationary catalysts that are in the mix. Back to tariffs, we talked about that last show. I believe that to be a economically contractive exercise. And it will cause, rates to come down, not go up. So, but all in all, I think next year will be good. I think we have earnings growth. S&P 2025 earnings growth for 2025 is 14.6%. 2026 is 13.5%. So we have strong growth. And if you look on an equal weighted basis, you're looking at almost 13% for next year and about 12% for 2026. So clearly, the heavyweight champions of the S&P 500 are going to still do the heavy lifting, but the other guys are coming along too.
Back to the bond side for a second, I want to ask you a question. So we talked on the last show, I believe it was the last show, that it's becoming more of a stock picker's market. There are certain times that when you're looking at where I'm going to put my money, it's as simple as, risk on, risk off, stocks versus bonds. I'm taking risk, I'm not taking risk. And at those times, I've heard the term used, it's a beta-driven market. Basically, if people are putting money in the market, it doesn't matter. They're just putting it in everywhere, across the board, and that kind of causes all stocks to move in the same direction, maybe some to a greater magnitude than others, but they're all kind of going in the same direction. Where now it's getting to a point where it was the last show, we were looking at, it's not, all of these factors aren't going to affect every sector, the same way, or even every individual company the same way. Every company's positioned a little bit differently, and there's a bigger premium now on having the ability to go through those reports and those analytics and be able to figure out which of the stocks are going to be the winners, which sectors are going to be the winners, how to sort through that a little bit. It almost sounds like what you just said about the bond market. It's kind of the same type of thing. It's not just a matter of interest rates, which direction are they going to go? You've got to break it down a little bit by, okay, the way we said it before might have been, okay, where's the market going to go? And you might have to ask the question, well, are we talking about tech? Or are we talking about staples? Are we talking about energy? Which sector are we talking about? Now, when we talk about interest rates, if I say which direction the rate's going to go, it's almost like you're coming back and saying, well, which side, what part of the curve are we talking about? Are we talking about the short end of the curve, the belly of the curve, the long end of the curve? Because it's going to react differently and behave differently. And some of that's just, I think, because we've been in this inverted state that has to get back to normal, right? So that's going to happen at some point, and that's going to cause rates to move and behave differently on one end of the curve than another. But would you say all of that put together, like, do you feel like it's more of a, not to say a bond picker's market in the bond side, but do you think it takes just a little bit more brain and a little bit more active awareness of what you're doing in the bond market now, as opposed to just dumping it in bonds across the board and assuming that they're all going to go in the same direction?
Well, I think next year it's going to take a lot of humility in the bond market. Okay. And that's what I learned this year a lot is specific to fixed income is humility, right? And we have to say,
Those are tough lessons, man. Those are tough
are,
lessons.
you know, experience is what you got when you didn't get what you wanted, you know? So,
I love
so
it.
I think the bond market is going to be approached with humility and care next year. So what we're going to do, what we're doing in the portfolios next year, and we have a great example of the difference. Now, this will change as the shorter end of the curve comes down, by the way, right? But let's look at two high yield positions, both SSGAs. You look at the JNK, the high yield corporate bond, right, versus the short duration high yield bond. It's called the junk, the SJNK, the JNK, or the SJNK, the short duration version of it, right? And you're looking at the average coupon on the JNK is 6.36%. You're looking at yield to maturity on that of 7.82%. 7.82% for the JNK. Okay. Whereas if you look at the short duration, 7.54. Okay. So what's the difference? There's a 1/3 less duration on the short duration versus the standard duration. So you're taking 1/3 of the interest rate risk away for the same yield. Okay. Now, as the shorter end comes down, that yield will come down. See what I'm saying? So we're going to have to probably endure a little bit of a lower yield in the back half of the year. Okay. But we might not. That's where the humility comes into play. So if I'm looking at an average duration of 3.31 on the short, and I'm getting 7.5% versus 5 years on the standard duration ETF, and I'm getting yield of 7.5%. Okay, well, I'll hedge that bet a little bit. That's good, because if as a shorter end comes down, obviously the shorter duration, those yields will come down and the price won't go up as much, right? Obviously, the longer duration, that would also see a bigger price increase if rates did come down. But I don't think there's enough juice for the squeeze right now. Okay, it would have to go down significantly, and I would have to have a pretty good idea that that's going to happen before I would say, okay, let's extend duration out here. We're not getting the term premium that we should be getting for the interest rate volatility that we're seeing. It's not like we're getting that risk premium that we're getting on the equity side, right? And back to a beta-driven market, what a beta is, what they're talking about is the beta coefficient. What a beta coefficient is an average of standard deviations across the time period based on certain modes, whether it's a daily close, a weekly close, a monthly close, whatever that close is over a specific time period. And it takes those standard deviations and averages them out. And it says, okay, now it takes a benchmark. It says this particular position, let's call it the S&P 500, has a beta coefficient of 1. And anything higher than 1 is more volatile. Anything lower than 1 is less volatile. And it's very, very simple to understand. If it has a beta of 1.1, it's 10% more volatile than the S&P 500. If it has a beta of 0.9, it's 10% less volatile than the S&P 500. Very simple to understand. But you can look, and when we look at building portfolios, obviously we're trying to get the best return what we can against a risk adjusted return, right? We don't, if the S&P 500 is going to return what we think is going to be about 16% next year, right? And we put your money into a portfolio and we return 18% next year, but we also gave 3 times the volatility of the S&P 500. Well, you had to endure a whole lot of rocky road, to get where you were getting, right? It's kind of like, well, we went on a nice vacation. We took dirt roads the entire way. That wasn't fun at all, but we got there. That's no fun. So what we do is we look at obviously beta coefficients of individual stocks, back to the stock pickers market, right? So beta coefficients over time typically are pretty stable. Like a good example is Apple. Okay. Apple has a beta coefficient of 1.24, which means to the S&P 500, which means it's 24% more volatile than the S&P 500. So if the S&P 500 moves 10% up, we can expect Apple to move 12.4% up. If it goes down 10%, we can expect Apple to go down 12.4%. Okay.
And to put that into like a real life if I have a portfolio and I'm aware of these, if I've been very conscientious of the way I've constructed my portfolio, and we have a really bad day, the market's down 2%. If I have a
Like
down
today.
day, and yeah, like today, and I look at my portfolio and I see that Apple's down 1.2%, I'm actually looking at that and feeling kind of good about it. Like I'm feeling like that's a win for Apple. Even though it's down 1.2%, it's not down the 2.48% that I would have expected it to be based on the volatility. I'm looking at that and saying that's a win. On the
Right.
flip side, if we're up 2% and Apple's up a half, I'm not counting that as a win. Even if it's up 1.9, I'm not even counting it as a win because I was counting on quite a bit more than that. So
Right.
that's, I mean, not that most people are really looking at it in those terms, but from a professional manager standpoint, that is, at least I would look at it that way sometimes. It's like, man, the market's down 5%, but at least Apple's only down 1%. That's a win. That's a huge day for Apple in my book.
Right. So if you look at the S&P 500 on a monthly close over the last 5 years, using the beta coefficient of 1 as the benchmark, it's returned 83.26% over the last 5 years. That's the S&P 500. Okay. Apple at 1.24 should have produced a return, 24% higher than that, which is about 106% over the last 5 years. It's up 250%.
A little better.
So you see what I'm saying? So you endured the volatility for a return of about 106%, but however, you received 250% return. So you got 144% risk adjusted premium. That's what you received. And that's good management. Okay. So another good example of this is Berkshire Hathaway, Baby Burke, right? The B shares. Okay. Those are actually less volatile than the S&P 500. Okay. They run a beta coefficient of 0.88, which means they're 12% less volatile. Okay. Back to 83% on the S&P 500. That means the Berkshire should have received a return of about 72%. Okay, I'm sorry, about 74%. Okay, that's about the number. So if you receive if Berkshire returns 74% over the last 5 years under that beta, that's fair. However, it returned 102% over the last 5 years. So it markedly outperformed, not just on an absolute basis of the S&P 500 of about 20%. It outperformed tremendously on a risk-adjusted basis, and that's what we look for. And obviously, a very extreme version of it would be like Nvidia. Okay, so Nvidia actually is a 1.66 beta coefficient, which means it's 66% more volatile than the S&P 500. Again, if the market went up 83%, it should have a return of somewhere around 130%. That'd be about the number, about 66% higher. It's returned 2,205% over the same 5-year period. So you see a tremendous risk-adjusted premium there. You see, and those are the things we look for. So it's not like the bond market where we're not getting enough term premium for the interest rate volatility that we're taking, so we're going to stay short duration. On the equity side, if you do the work and you look at these beta coefficients, say, for instance, if you look at Nvidia, it's 1.66. Over the next 5 years, it probably won't change all that much, right? It'll probably end up to 1.5 to 1.75 in that range. It's not, betas don't change all that much. They typically cool off slowly as these companies mature, okay, and as their growth rates slow down a little bit. But it's not going to be all that wild, right? I don't expect it to spike, that's for sure. Okay, but like I said, anything happen. So at that point in time, okay, so I can kind of get an idea of what kind of volatility I'm gonna get with these positions. Okay, so how's that going to perform against the benchmark, right? That looks like a fair trade, risk to return. I mean, clients, yeah, they don't love days like today. They don't love days when obviously Nvidia is down 3% and the market's down 1%. But they love the days when Nvidia is up 4% and the market's down 1%. And that's how you return it over time. So as long as we're looking at portfolio performance through not just an absolute prism, but a risk-adjusted prism, that usually makes clients, me, everyone sleep better at night.
Well, and I had a client several years ago, and their investment philosophy basically was, I'm young, I'm aggressive, I want to take as much risk as possible. So when you look at their portfolio, I mean, that's what they had. The most aggressive, high beta, small cap funds, they would dump 15, 20% of their portfolio into a brand new startup tech company that had just gone IPO. They were as reckless as they could possibly be. And they were pretty proud of their returns over their investing career. I mean, they had averaged, I don't know, 15% or something like that versus a market that had averaged 12, and they had certainly outperformed me as the professional at 10, whatever the case may have been. But the thing about it is, if you play that game long enough, the thing that a lot of people don't realize about that is when you start talking high standard deviation of portfolio, okay, well, if you've got a portfolio with a standard deviation of 25%, that means 2/3 of the time your portfolio is going to be up or down 25%. But about 5% of the time it's going to be up or down more than 50%, and about 1% of the time it's going to be up or down 75%. Well, a 75% loss is not offset at all by a 75% gain. So that 1 out of 100 years that you lose 75 isn't offset exactly by the 75% return you got back on the other side. And that's where you start to get into the wacky financial math of, hey, a 10% loss takes an 11% gain to break even. A 25% loss takes a 33% gain to break even. A 50% loss takes a 100% gain to break even. And a 90% loss takes a 1,000% gain to break even, right? So when you start to play into the real math of the geometric returns in the fancy world, the fancy term for it, that high risk doesn't always equal higher returns in the long run. I think that was what we talked about yesterday a little bit, and it was something you had said was really interesting to me about Trump a few shows ago, that Trump you thought would lead to a higher volatility market but also a higher return, but that Harris would most likely lead to a little bit lower volatility but a little bit lower return. And I agree with that. I think that makes a lot of sense. But it also kind of goes backwards to what a lot of people think a lot of times. And a lot of times your calm, steady returns take place in the better markets. 2017 is a good example of this. I remember 2017, the market was up like 27% or something crazy. It was a great year, 2017. The market was never up or down more than 0.5% in a day that year. It was just like every single day was about 0.3, 0.4, 0.3, 0.4. A bad day, it might be down 0.1. A great day, it might be up 0.7. But it was a really, really tight band of returns. If you looked at that year on a chart, it was almost a straight line. It was a couple little bumps here and there. But then a lot of your really volatile years, 2018 wasn't a great year at all. I think we were down pretty big that year. There was a lot of volatility. Usually a lot of the volatility kind of tends to happen in bear markets or flat markets, and low volatility happens in rising markets. But that does kind of go against the grain of high risk, high return, low risk, low return. So I guess high risk doesn't always mean higher returns, but sometimes higher risk does mean higher returns. Sometimes it doesn't. It's just one of those things that I think sometimes we hang our hats on assuming that it's always the case. It's not always that. There's always more to it than that.
Well, one of the best sayings I ever heard, I don't know who coined it, but I heard it from Howard Marks, was if high risk investing could be counted on for high returns, then they wouldn't be high risk. Right?
That is so simple that that's one of those things. It's so simple that it's profound, and it's so profound that it's simple. I don't know which it is,
right,
but it's so true. Yeah, 100%.
Yeah, if risky investments could be counted on for higher returns, then they wouldn't be risky. So that's the point. That's where the professional money managers come in, and they understand the fundamentals, and they understand the granular nuances of individual companies and indexes and portfolios and how they're constructed for a certain period of time. And they know what to do and when to do it, right? Versus, hey, I'm going to put my money in this penny stock because I think it'll, quintuple in the next 15 minutes. That's just, and that's an extreme example of it, of course. But if you look at the best days in the market, the strongest days that happen are in bear markets, because that's when the market is typically coming out of something bad, or it's in a volatile state. And 2017 was an interesting year. I think that year was around 18-19% for that is what we had that year. But I remember that year well. I just could have stayed home. There's just nothing to do. The market just every day just went up, and it was really quiet, and it was wonderful. That was attributable to the corporate tax cuts. Is the market immediately priced in corporate tax cuts. We had a president who was very business friendly, and the market just kind of wanted to sit back and say, okay, well, how's this going to play out? Okay, because they knew they had a cushion now to deal with that they didn't expect they were going to have. But if you remember, and we talked about this a few shows ago, is what if you look at the MOVE index, which is the VIX of the bond market, that thing was all over the place. Okay. Remember, right after he got elected, the bond market just was like, a slaughterhouse. It's crazy. So he affected the fixed income side as far as volatility is concerned, but not so much the equity side. But the equity side did pretty well. But as the economy started to, really gain traction and really start to take off again, 2018 came in, and then we had a lot of volatility because we had that massive spike in the very early of 2018, right? I remember like the RSI and the S&P 500 hit like 88. It was nuts. It was crazy. And then it just kind of petered off all year, didn't do much. And then we had Jay Powell. He was new then. He was the new chairman. And he said, okay, well, obviously rates are too low now. We need to get these rates up. So we're going to increase rates by, a quarter point. We're just going to put this thing on autopilot. And once he said that, all hell broke loose, right? The market thought this guy's going to put on 25 basis points in perpetuity. So from then until Christmas Eve, the market just absolutely, cratered. And then he finally came out and he understood the power of communication. And again, experience is what you got when you didn't get what you wanted. Jay Powell, I think, learned, and to his credit, and we can all discuss the transitory inflation thing. And yeah, they missed that. No one's perfect. But his communication has been pretty damn good. He understands how powerful his words are. So, back to the Fed, and what we think is going to happen with them next year. Something interesting is happening next year is Austin Goolsbee. He's coming back on as a voting member next year. And I really like Austin Goolsbee, because he is not all that concerned with agreeing with the other Fed members. He's a dove, which is good for the markets, but he's not a dove because he wants to be a dove. He's a dove, or he's a wise owl, or whatever they're calling themselves now, because I think he's trying to skate to where the puck is going. And they know if this thing stays too restrictive for too long, even with Trump in, even with a low regulatory environment, even with a pro-business president in, that's going to really harm labor. That at some point is going to cut right into the muscle of labor. And that is a bell that is very, very hard to unring. Okay. And I think he knows that. And he said, we are materially restrictive. He recently said that. And the other thing is he's pretty outspoken. He's incredibly articulate, and he does it in kind of a folksy way, right? So I think he's going to be an influence in those meetings, and I think that's going to be a little bit of a tailwind for some of those rate cuts next year.
Another quote I want to insert here, I saw the other day. It was really great. It said that it's better to develop humility from a failure than to develop pride and arrogance from a success. There's something along those lines. And I think that is, you're right. If you look at it that way, humility does bring some great lessons with it, that if you're humble enough to learn from them and not just blame it on external factors that were out of your control instead of your own arrogance, they can develop you into a much better money manager. But if you just arrogantly say that everything that went against you was just bad luck, you don't learn anything and you just stay a bad manager forever.
Well, my uncle used to tell me a lot. He's still around, and I love talking to him. And he says, he told me this, I think I was in my early 20s. He said, the difference between arrogance and confidence is proven ability. Okay. However, I would add to that now. The difference between arrogance and confidence is proven ability and humility, because confidence comes with humility. Confidence comes with, I might get this no matter how good I think I am, no matter how much work I have done, no matter how good I have been in the past, okay, I can still get this wrong. So what am I missing? And if you approach portfolio construction or the market direction or the interest rate direction as a whole, knowing that it's really, really, really easy to get it wrong, okay, you're then trying to look for things that I was trying to look for things that you're missing. What are you missing? What are you not bringing into the equation? And that really helps to round out kind of the thesis, if that makes sense. And again, is the market going to finish next year at 71.50? No, it will not hit 71.50. It might go 72.50. It might go 68.50. It might go 7,022. I don't know. it won't hit that number. It's an idea of directionally where are we headed and what general area are we going to end up in. Okay. So, if although we have the 7150, that's kind of a base case, but I would call it a base / bull, if that makes sense, because we have Trump and we have this Trump factor now we have to deal with. Just like we said in May and June, we were talking about this. We thought, well, we had we had a 5350 base case for this year, a 5600 bull case, but then we said the Trump factor is different. If he gets in, this thing can just bang, and then it goes right to 6,000. And that's exactly what happened. So I'm kind of doing this 7150 as a base case bull case, because I think the bull case is more probable than the base case. The base case is probably, I would have to agree with Tom Lee, that the base case is probably 66 to 6,800 in that range. But I'm going to favor the bull case of that kind of 71 to 7,200, simply because there's just these animal spirits have come back. And I believe that interest rates are directionally lower, right? And I think the Federal Reserve will surprise people next year with them, because remember, muscle memory is tough to unlearn, and scars, you see them every day, right? And they learned from this is transitory, they've learned from waiting too long and the damage that it can cause. So I don't think they're going to do that this time. I think they're going to get ahead of this thing, and they know they can always say, hey, they're no longer really, they're not trying to be data dependent anymore. Now they're trying to read the tea leaves a little bit, with some of their communications. And frankly, I applaud that. I think that's what they should be doing, because you're talking about an incredibly educated, bright group of people that their whole job in life is to keep prices stable and keep employment high. That's it. So if they think having a restrictive interest rate is good for employment, well, I know they know that's not good, and they're going to do something about it. So that's my take.
Awesome stuff. Well, so rolling into the new year, next time we chat will be, let's see, what we got here. It'll be January 10th, I believe, something like that. So have a new little nuance we're going to throw out in the end of January 2025. Do you want to announce that one here? So I guess our next show will be, I don't have the calendar in front of me, I think it'll be like January 10th. Then we'll have January 24th. And then I think we're doing a special edition show either on the 24th or the 31st, somewhere in there.
Yeah, we're gonna start doing a once a quarter. We're going to do a webinar where we review the Intelligent Investment newsletter. We go through it and we add context to it, right? And it's to ARPG clients, to invitees, and we hope to talk to lots of people. And we still have a few, speed bumps to drive over as far as compliance is concerned, to make sure it's good. And we're going to try to make sure that obviously the portal that people engage in, where they can ask questions to me directly through the portal while we're talking, and it will be live. So, all my stuttering and playing with my hair and, picking my ears and, cracking my nut. Yeah, that's all, I'm going to stop doing that.
We'll have to practice that in the next show. You guys will get to see how long we actually record this thing. It's a 45-minute show. We record for 4 hours. You have no idea how much I have to edit
right.
out. Nah,
with
totally kidding.
With my 17 bathroom break.
But no, I'm excited about that. And then the replay will be available as a special edition Intelligent Investment show. That'll be an extra chapter that we'll have out there, and I'm excited about it. I actually have some really cool things that I'm doing on the production front as well over the next few weeks that will be getting the Intelligent Investment show out on a lot more platforms and make it a lot easier for everyone to consume. And we're going to have our clips and all this kind of stuff out on all the social media outlets. So check us out. I will add some links to that and keep everybody posted on that in the next little bit. But appreciate everybody listening. And hey, if you're a regular repeat offender, if you're on YouTube, subscribe to the channel. If you're on your podcast provider of your choice, hit the subscribe button. Join us on a regular basis. We'd love to have you more and more often. And Matt, Happy New Year to you, brother. Hope you have a fantastic last few days of the year. Safe and healthy and happy New Year's. And look forward to seeing you on the other side, man.
Happy New Year. I will see you next year, my friend.
All right. See you, brother. As always, the Intelligent Investment Show is for your entertainment, education, and general amusement purposes only. It is not intended to be financial advice or investment advice of any kind. Neither Matt nor I or any of our companies or associated entities know anything about your financial circumstances, so it would be unwise for us to tell you what to do with your money. We encourage you to seek a professional if you do have questions about your portfolio or your financial plans. If you would like to reach Matt and his team, you may do so by giving him a call at 702-655-8300 or visiting intelligentinvestment.com. We thank you for joining us. We'll see you next time.